Et bonjour tout le monde. Good morning, everyone. My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada. I'll be moderating this press conference about today's interest rate announcement and the publication of our monetary policy report. Le gouverneur Macklem va prononcer une déclaration préliminaire et après on va tourner aux questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. So at this point, I will turn it over to Governor Macklem for his opening remarks. À vous la parole.
Thank you and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we raised our policy interest rate by 25 basis points to 5%. We are also continuing our policy of quantitative tightening. This decision reflects two broad considerations. First, monetary policy is working, but underlying inflationary pressures are proving more stubborn. We have made considerable progress in the fight against inflation. CPI inflation has fallen from a peak of 8.1% last summer to 3.4% in May. But even as headline inflation has come down largely as we forecast, underlying inflationary pressures are proving more persistent than we expected. Higher interest rates are needed to slow the growth of demand in the economy and relieve price pressures. Second, we are trying to balance the risks of under and over tightening monetary policy. If we don't do enough now, we'll likely have to do even more later. But if we do too much, we risk making economic conditions unnecessarily painful for everybody. We've come a long way, and we don't want to squander the progress we've made. We need to stay the course to restore price stability for Canadians. Cette décision reflète deux grandes considérations. Premièrement, on a fait beaucoup de progrès dans la lutte contre l'inflation. La politique monétaire fonctionne. L'inflation mesurée par l'indice des prix à la consommation est passée d'un sommet de 8,1% l'été dernier à 3,4% en mai. Mais même si cette baisse est généralement conforme à nos prévisions, les pressions inflationnistes sont plus persistantes que prévu. Il faut des taux d'intérêt plus élevés pour ralentir la croissance de la demande et alléger les pressions sur les prix. Deuxièmement, on tente de bien dosser notre resserrement monétaire. Si on n'a fait pas assez maintenant, il faudra probablement en faire encore plus par la suite. Et si on en fait trop, on risque de créer une situation économique inutilement difficile pour tout le monde. Il ne faut pas que nos progrès ne servent à rien. C'est pourquoi on doit garder le cap si on veut rétablir la stabilité des prix pour la population canadienne. Laissez-moi vous expliquer ces considérations et quelques points clés des délibérations du Conseil de direction. Depuis le début de l'année, la croissance mondiale a été plus forte que prévu. La baisse des prix de l'énergie et du taux d'augmentation des prix des biens ont aidé à ralentir l'inflation dans le monde. Mais il y a encore des pressions inflationnistes dans le secteur des services. Elles sont alimentées par la demande robuste et les tensions sur les marchés du travail. On estime que la croissance économique mondiale en 2023 va dépasser nos prévisions de janvier et d'avril. It's a similar story in Canada. Growth has been surprisingly strong and the economy remains in excess demand. Consumer spending on services remains robust. And while spending on many goods that are typically sensitive to interest rates has slowed, it has not slowed by as much as we expected. The housing market has also seen some pickup in activity. Several factors appear to be supporting household spending. The labor market remains tight, even if there are some signs of easing. The unemployment rate has increased slightly, but remains historically low, and wage growth has been between 4% and 5%, higher than what is consistent with price stability. Many households also accumulated savings since the beginning of the pandemic. Some households have cut back on spending because inflation and higher interest rates have eaten into their budgets, and some are being severely squeezed. But for many, larger savings may be acting as a buffer and supporting consumer spending. Rapid population growth is contributing to both supply and demand in the economy. Newcomers to Canada are entering the labor force, easing labor shortages. But at the same time, they add to consumer spending and the demand for housing. Turning to inflation, while CPI inflation has fallen relatively quickly, much of the downward momentum has come from lower energy prices and base year effects as large price increases we saw last year fall out of annual inflation. We are still seeing large price increases in a wide range of goods and services. Our measures of core inflation, which we use to gauge underlying inflationary pressures, have come down, but not by as much as we expected. 3 months rates of core inflation have been around 3.5% to 4% since last September, suggesting little downward momentum in inflation. Consumer and business expectations for near-term inflation are moderating, but they're still high. And businesses are saying they are still increasing their prices more frequently than they did before the pandemic. Looking ahead, we continue to expect economic growth to moderate and inflation to ease, but this will take longer than we forecast in January and April. As the global economy slows and higher interest rates work their way through the Canadian economy, we expect economic growth to average about 1% through the second half of this year and the first half of next year. This means the economy moves into modest excess supply in early 2024, and this should relieve price pressures. CPI inflation is forecast to remain about 3% for the next year before declining gradually to the 2% target in the middle of 2025. This is about 6 months later than we expected in April. Our decision to raise the policy rate reflected the persistence in both excess demand and underlying inflationary pressures, combined with our outlook for economic activity and inflation. The consensus among the Governing Council was that monetary policy needed to be more restrictive to bring inflation back to the 2% target. These decisions are difficult, and we did discuss the possibility of holding rates unchanged and gathering more information to confirm the need to raise the policy rate. On balance, our assessment was the cost of delaying action was larger than the benefit of waiting. Elevated inflation is a burden on Canadians, especially the most vulnerable. We are also acutely aware that higher interest rates are making life more difficult for many Canadians. And we know many Canadians are asking, is the Bank of Canada done raising interest rates, or will rates need to go still higher to relieve inflationary pressures? The short answer is we will be taking each decision based on the available information at the time. What we can say is that monetary policy is working, and we know it will take more time for the full effects of past interest rate increases to work their way through the economy. With the increases in our policy rate in June and July, our outlook has inflation going back gradually to the 2% target. But several things need to happen for inflation to continue easing. And we are particularly concerned about two upside risks to the outlook. First, we have been surprised by the persistence of excess demand and underlying inflation in Canada and globally. We know that higher interest rates are having an impact, but how big their impact will be is uncertain. Second, with the downward momentum in inflation waning and our forecast suggesting inflation will be around 3% for the next year, we are concerned that the progress to price stability could stall, and inflation could even rise again if there are upside surprises. As I said, we are trying to balance the risks of over and under tightening. If new information suggests we need to do more, we are prepared to increase our policy rate further. But we don't want to do any more than we have to. These decisions will be guided by our assessment of incoming data and the outlook for inflation. We need to see demand growth slow, wage pressures moderate, and corporate pricing behavior normalize. We will also need to see near-term inflation expectations and measures of core inflation come down further. Avec les hausses du taux directeur de juin et juillet, on prévoit un retour graduel à la cible de 2 %. Mais plusieurs choses doivent se produire pour que l'inflation continue de baisser. On est préoccupé par le risque que le retour à la stabilité des prix puisse stagner et l'inflation pourrait même remonter s'il y a des surprises à la hausse. Comme je l'ai dit, on tente de bien doser notre resserrement monétaire. Si des nouvelles données indiquent qu'il faut en faire plus, on est prêt à relever encore le taux directeur. Mais on ne veut pas en faire plus que nécessaire. Nos décisions vont être guidées par notre évaluation des nouvelles données et les perspectives d'inflation. Il faut que la croissance de la demande ralentisse, que les pressions sur les salaires se modèrent et que les entreprises reviennent à leurs pratiques de fixation des prix habituels. Il faut aussi que les attentes d'inflation à court terme et les mesures de l'inflation fondamentale descendent encore. Let me conclude. The substantial drop in inflation over the past year is welcome news for Canadians. But monetary policy still has work to do. Our job is not done until inflation is centered on our 2% target. That's the level that helps the economy grow sustainably, restores competitive forces in the economy, and gives Canadians the price stability they need to budget and invest with confidence. And with that summary, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Thank you, Governor. Let me quickly go through the housekeeping and we'll get to your questions. We do have a number of reporters here in Ottawa at the bank, as well as some on the phones. We're going to start here in the room before going to the phones. I will ask everyone to limit yourself to one question, please, just to give every outlet the opportunity to participate. If I forget to do so, please state your name and affiliation. And I'll remind people on the phone to please only unmute your line to ask a question and then go back on mute as soon as you're finished. That way everyone can hear both your question and the answer. It's the *6 button on your phone that toggles you between mute and unmute. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6 et pour enlever, faites étoile 6 encore une fois. Avant de poser une question, veuillez vous identifier et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. Okay, so with that, let's go to our first question here in Ottawa, and I'm going to call on Steve Shearer from Reuters, please.
Hi, Governor. Thanks for talking to us today. I'm a bit torn as to which question to ask. Let me ask this one. A few months ago, in January, you paused rates, and when you did, you indicated that it would be a pause. And since then, we've seen the housing market recover. And you said today in the statement that it's adding to inflation. Do you think that it was a mistake in your messaging in January to say that? Should you not have maybe just said, we're not raising rates today, but we're going to keep watching things?
Well, let me just remind you what we said in January, what the situation was in January. In January, we had over the previous 10, 11 months, raised rates very forcefully. It was the most rapid increase in the Bank of Canada's history. And so it made sense to pause. We know monetary policy works with a lag. We knew it was going to take some time for those rapid interest rate increases to feed through to the economy. What we said at the time is, yes, we're taking a conditional pause to assess whether we've raised rates enough to restore price stability. As I said, I think that made a lot of sense over time. What we've seen in the subsequent 5 months is that, I'd say for the first few months, data was coming in largely in line with our projections. But in the last 2-3 months, what we've seen an accumulation of evidence pretty consistent across a range of indicators that there's more excess demand in the economy. Excess demand is proving more persistent. Underlying inflationary pressures are proving more persistent. So in June, we raised by 25 basis points. Obviously, we've raised a further 25 basis points today. What we're saying now is that we're taking it one decision at a time. We've laid out our forecast for inflation. We've been clear about the indicators that we're following, and we're doing our best to balance the risks of under and over tightening.
Thank you. We'll now go to Najoud Al-Malise from the Canadian Press, please.
Hi, Governor. Kind of related to that question. The new forecast for inflation suggests rates aren't going to come down anytime soon, or at least not the same timeline that people may have expected previously. Can you talk a little bit about what today's rate hike and the new projection means for interest rates moving forward, not just in terms of like how high they'll get, but in terms of the impact having elevated interest rates for longer might mean for the economy?
Well, look, the short answer is the same answer to the previous question. We're going to be taking each decision one at a time. We're going to have, we'll take each decision based on the best available information on that time. What can we say? What we can say is, what we see is that monetary policy is working. Inflation's coming down. We also know that monetary policy works with a lag. So we know that the full effects of the past interest rate increases we've already done have not fed through. We will be seeing that impact going forward. The other thing we're seeing, though, in the economy is that those underlying inflationary pressures, they are stronger than we expected. With the increase in our policy rate in June and July, our own forecast has inflation hovering around 3% for the next year, and then coming down gradually to the 2% target in the middle of 2025. So, I mean, what does that mean? I think it means that we think we're close, but what I would highlight is that there are a number of things that have to happen for that forecast to be realized. There are a number of things that have to happen for inflation to ease back to target. And as I mentioned in the opening statement, there are two that we're particularly concerned about. We're concerned that we've been surprised by the persistence of excess demand and underlying inflationary pressures. We know that our past interest rate increases are feeding through. They're having an impact, and there's more to come. But what the total impact of those interest rates is ultimately is uncertain. And then the other thing is, in our own forecast, inflation hovers around 3% for the next year. What that's telling you is the downward momentum in inflation is waning. And we are concerned that if we're not careful, the progress to price stability could stall. And if you get some upward surprises from there, inflation could even move back up. So we've been clear about the indicators we've been watching. I think it's clearly too early to be talking about interest rate cuts. We are certainly trying to balance the risks of over and under tightening, and we'll be taking it one meeting at a time.
Next, I'll call on Rahul from Epoch Times, please.
Thank you for taking my question. Regarding the box on household financial health and the strength in consumer spending, you say there's a smaller portion of households who are experiencing financial stress and that many households remain healthy. In a way, it sounds too good to be true, but I would think this is contributing to the consumer spending, which remains strong. But how does this match up with other reports of more than half of Canadians being less than $200 away from being able to pay their monthly bills, and does that factor into the Bank of Canada's decision to raise rates again because you feel that household financial stress is limited?
Well, Rahul, we see some of the same headlines that you see, that you're talking about. And it's one of the reasons we did the work that contributed to the box you're referring to in our monetary policy report. We wanted to take a bit of a deeper dive. When we're looking at our forecast and in general, the work we do, we deal a lot in sort of aggregate numbers and averages, but we know that inflation and interest rates, the response to inflation, affect people very differently. And in particular, we know, we have said this many times, we know that the most vulnerable Canadians are the ones that are hurt most by both by inflation by higher interest rates. So that's what that box was designed to do. We also survey Canadians, and we've included some of the feedback we get on our surveys in our monetary policy report. But what we're looking at in that box is the data. And really, there's two things that we think are helping buffer many households from both inflation and interest rates, and that is the savings they accumulated over the course of the pandemic. You can see 3/4 of households have accumulated quite a bit more savings than they had prior to the pandemic. And then the other thing that we think is supporting basically confidence and buffering Canadians from some of the impacts is the strong labor market. People feel confident about their jobs and their income, and many are seeing wage increases. So we definitely think those two things are contributing both to reducing the financial stress for some, and also contributing to that consumption that we talk about. But we are acutely aware that this is a very difficult period for some Canadians, and interest rates and inflation are making things very difficult for some.
Paul Vieira of the Wall Street Journal, please.
Governor, in the statement, I'm sorry, I'm just going to I want to get the exact wording. In the statement, it said, the bank said that officials were concerned that progress toward the 2% inflation target could stall, and thereby jeopardizing the return to price stability. If that was the case, why did officials discuss the possibility of holding rates at this meeting leading up to the July 12th? Why was there even a consideration, given some of the warnings you put in the statement and in the new economic outlook?
Well, Paul, I think that really reflects the fact that we're trying to balance the risks of under and over tightening. You know, we know that if we don't do enough now, we'll likely have to do even more later. We also know, though, that if we do more than we need now, it's going to be unnecessarily painful. So when you deliberate, you want to look at the options. I think, you know, strategically, the Governing Council was very much of the view that monetary policy was not restrictive enough. We also just, you know, we discussed, you know, does that mean we should raise now, or should we gather more information and confirm that? I think there was a clear consensus that we didn't see a big benefit of waiting. We were pretty convinced that we needed to move up because of the persistence of excess demand and the persistence of these underlying inflationary pressures, and the risk that if, you know, we need to keep getting inflation gradually moving back to the target. If it stalls and we get some upside surprises, things could be more difficult.
And Paul, I'd add, it comes back to Raul's question that he just asked. You know, we are acutely aware that these decisions have real impacts on Canadians, so we always debate the options, and we never make a decision lightly.
Okay, I'm going to call on Mackenzie Gray from Global News now, please.
Hi there. On housing, in the report here, you say that high prices are likely to persist and boost inflation. Two things on that. Why do you think house prices are going to continue to rise? And secondly, how much do increased house prices weigh in your decision-making on increasing rates or potentially keeping them at a higher level for longer?
Well, the short answer to why house prices keep going up is supply. We've said that for a long time. There's lots of things that go into house prices. Certainly, housing is very sensitive to interest rates. So when interest rates move, it affects house prices. But one of the fundamental things that's holding up house pricing in Canada is there's just more demand than there is supply. One of the things that's contributing to the demand for housing now is an increase in population. We've seen a return to immigration levels that we had pre-pandemic, and quite a high surge in immigration more recently. So those things are contributing to keep housing prices high. Housing is a component of overall inflation, but we target inflation. We don't target house prices, and we don't target any one sector or one item within the CPI basket.
Mark Rendell, Globe and Mail, please.
Thanks for taking the question. In terms of the growth outlook, it looks like growth in the second half of the year and in the first half of next year around 1%. That doesn't look like a contraction. We still haven't got that recession that people were talking about last year. Based on the new growth forecast, is this a soft landing scenario, or is a recession still a possibility on the cards?
So, as you said, we've got, growth, demand in the economy has surprised us on the upside. You can see that our growth forecast for this year is revised up. We still think, though, that the increases in interest rates are feeding through to the economy. We still think growth will slow. As you indicated, we think growth is going to average around 1% for the next year before picking up after that. So what that's telling you is, in our forecast, there is a path back to price stability while maintaining growth. So there is no recession. We need a period of growth below trend, below potential, to let supply catch up with demand. That's what's going to relieve those price pressures. But we do think that there's a path back to price stability with the economy still growing.
Okay, next I'm going to call on Greg Quinn of Market News, please.
Good morning. Why didn't the first 8 hikes in interest rates, including the 100 basis point move last July, do more to slow down the economy? And does this suggest there's something still missing in your modeling or in monetary policy beyond lags?
Well, Greg, I think we have to be a little bit humble about exactly how the monetary transmission mechanism is working. But I think what we see is that monetary policy is working. Inflation has come down a lot. It was 8.1% last summer. It's 3.4% now. So it is working. And if you look under the hood, you can see that it's working where you'd expect it to work. I mean, when we raised interest rates, we saw housing slow quite sharply. You're seeing most interest-sensitive goods, so things that people buy on credit, household appliances, furniture. You have seen demand for those things slow. But it is true that they haven't slowed as much as we thought they would. Housing activity has ticked back up. Durables have slowed, but not as much as we'd expected. So why is that? We think basically that there's 3 things that are providing more underlying support to demand in the economy. First of all, the labor market remains tight. The unemployment rate, it has ticked up a bit, but it's still historically low levels. Wage growth's been running 4 to 5%. That's above what would be consistent with achieving price stability. We're seeing some easing in the labor market, but it's been more gradual than we expected. The other element, Carolyn already mentioned, most households have accumulated savings through the pandemic. That may be buffering them from the effects of inflation and higher interest rates on their budget and supporting consumption. And then the third element is population growth. Population growth has increased. We've had a big increase in immigration, more temporary foreign workers in the country. That's adding both to demand and supply. On the supply side, you can see that's a factor that's easing some of the labor shortages and is supporting, what you do hear from companies, from firms, is that labor is more available. They are filling those jobs. Vacancies are coming down. Some of the pressure in the labor market is gradually coming out. But those new entrants into Canada, they're also new consumers. They're new renters. They'll probably ultimately become new home buyers. So that's adding to demand as well. So we do think monetary policy is working, but there is just more underlying strength. And so it's got to work a little harder and it's going to take a little longer, as you can see in our forecast, to relieve those price pressures.
Okay, next on my list, I had Annie Bergeron Oliver from CTV.
Hi, thank you very much for taking our questions. I'm just wondering what your message is to middle-income Canadians who feel frustrated and feeling the daily pinch of high interest rates, whether it's trying to buy a new car or buy new furniture on payments. And this is only made worse by high inflation, especially when it comes to food.
Look, I understand that, we understand that there's no easy path to restoring price stability. We understand that inflation's a burden on Canadians, and we also understand that higher interest rates are squeezing many Canadians. You asked me what's the message. I think there are three key elements to the message. The first is inflation has come down a long way since last summer. And that means the cost of living this summer is rising a lot more slowly than it was last summer. And that is welcome relief to Canadians. But the second message is we know Canadians are still coping with large price increases for many of the goods and services they buy. And that's particularly affecting lower income Canadians, because they have the least ability to afford it. I mean, one way to see this is if you look at the proportion of the goods and services in the CPI basket that are rising faster than 5%, it's a little over half. I'll say that again. A little over half the components of the CPI basket, their prices are rising more than 5%. So what is that? Well, if you look across the basket, meat's up 6%, bread's up 13%, coffee's up 8%, baby food's up 9%. If you look at food overall, food in stores overall, it's up 9%. Rent's up 6%. If you look at, there's also a range of other services that are over 5%. If you're planning to take a family holiday this summer, hotel prices are up 13% from last summer, restaurants up 7%. So, what Canadians, what is inflation? Inflation is a generalized increase in prices. And when you look across the basket that Canadian households are consuming, they're still seeing, too many goods and services with price increases. So the third part of the message is to relieve those price pressures. Yes, we do need to slow demand in the economy. That's what's going to relieve those price pressures. And the way we do that is we raise interest rates. We know it's difficult, and we are doing our best to try to balance the risks of over-tightening and under-tightening. We are committed to restoring price stability. That is a benefit to all Canadians. We don't want to make it more difficult than it has to be.
OK, je vais demander maintenant si Francis Hébert-Bernier, indépendant.
Bonjour, merci de prendre ma question. Vous dites que le marché du travail est encore très serré puis que les augmentations de salaire sont encore très élevées. Mais bon, ça s'est quand même relâché dernièrement beaucoup. Est-ce que vous pensez qu'on est près du but, encore très loin au niveau du marché du travail?
Ça commence. L'ajustement commence. Les postes vacants ont diminué. Ils étaient très élevés. Ils sont encore élevés, mais un peu moins élevés. Il y a un graphique dans le rapport sur la politique monétaire qui montre le taux de croissance de main-d'œuvre relatif au taux de croissance de population. Et après une période de temps où le taux de croissance main-d'œuvre était beaucoup au-dessus de croissance de population, mais maintenant c'est un peu en dessous. Donc, ça suggère que l'ajustement dans le marché de main-d'œuvre commence. On anticipe que avec le ralentissement du croissance, du demande dans l'économie, on anticipe qu'on verra un marché de main-d'œuvre mieux équilibré et après un bout de temps, le taux de croissance des salaires va diminuer cohérent avec notre cible. Ça va prendre du temps et le message dans notre prévision, c'est cet progrès est un peu plus lentement que prévu.
Okay, and our last question in the room is from Randy Thantong Knight of Bloomberg News, please.
Hi, Governor and Deputy Governor. What are your thoughts on the current high levels of immigration that we're seeing? Do you see it as being more inflationary or disinflationary in the short run?
I mean, the short answer is that on net, it's probably roughly neutral, but it's affecting different parts of the economy differently. So, we're starting with an economy that's in excess demand. The economy's overheated. The immigration adds supply. It adds new workers. Immigrants coming, many of the immigrants coming in, the labor market's very tight. They're finding jobs very quickly, some taking a little longer. But, what we're seeing is the labor market is snapping up those new workers pretty quickly. That's adding to supply, and that is easing some of the labor shortages, the pressures in the labor market. And if you can ease the cost structure the cost structure for companies, that helps ease inflationary pressures. On the other hand, these new immigrants, these new entrants in the economy, they're also new consumers. They're new renters. They're new home buyers. So it's also adding to demand. It's hard to know exactly what the net effect is, but I think the main message is that it's adding to both demand and supply. If you start in an economy with excess demand, you add both demand and supply, you're still in excess demand. And what we're seeing is that the excess demand in the economy is more persistent than we thought. And so it's taking, we've raised rates in June and July, and it's taking a little longer to get inflation back to target.
Okay, we're going to go to the phones now. I've got 7 on the list, and I'd like to see if we can get through them all, please. We're going to start with Amber Canwar from BNN, please. Amber. Amber, it's *6 for everyone to mute, *6 to unmute. Amber, are you there?
Can you hear me now? Can you hear me now?
Yes, we can.
Yeah,
Amber.
we can hear you.
Wonderful. Governor, thank you for taking my question. When you look at
Oh, we're losing you.
rate hikes have contributed to inflation through increased mortgage costs.
Oh, Amber, you need to get closer to the mic. We can't really hear you.
I don't think Amber can hear us.
Whether that's making inflation and supply shortages worse.
Amber, I'm sorry, we couldn't hear that. Can I ask you to repeat that really quickly, please?
Can you hear me at this point?
Yes.
Okay, so I'll try this one more time. When you look at the components of inflation, rate hikes have contributed to inflation through increased mortgage costs. At the same time, fewer homes are being built because financing costs have gone up. How do you factor that into your thinking on whether rate hikes are making inflation and supply shortages worse?
Amber, increasing interest rates is the instrument that we use to try to moderate demand and relieve inflationary pressures in the economy. So if we hadn't raised interest rates, inflation would be a lot higher than it is today. Now, of course, for many Canadians, they have a mortgage. That's a major expense for them. So when you raise interest rates, cost of mortgages, cost of borrowing costs go up. And so that does boost that component of the CPI. And of course, if you take things out of the CPI that are going up, what's left is going up more slowly. So yes, if you take mortgage interest out of the CPI, instead of 3.4, you're left with 2.5. On the other hand, if you take things out that are falling, what you're left with is going up. For many Canadians, gasoline is a major expense. If you take gasoline out, what's left is going up at 4.4%. I think to go back to my previous question, I think what Canadians are seeing is that for many of the goods and services they're buying, prices are going up too quickly. That's a burden on Canadians. With respect to the impact higher interest rates has on the housing market, what you've seen is when we raised interest rates, you saw a pretty sharp slowing in resales. You saw a pretty sharp slowing in housing activity. That's that's largely what you'd expect. Housing is a very interest-sensitive sector. It's one of the first places you're going to see the effects of monetary policy. We have been surprised, actually, that the housing has started to bounce back as quickly as it has, and that's one element of many where you've seen more persistence in demand in the economy than we expected.
Next, I'll call on Kat Eschner from TVO, please. Kat, are you there? Okay, I'll come back. Let me call on Max Sato from Mace News, please. Go ahead, Max. Remind everyone, *6 to unmute.
I hear somebody.
Yep, someone's there.
It's Barbara Schechter at the Financial Post. I just unmuted to try to get ahead of things.
You know what, Barbara? I'll give you credit for that. Go for it. You're up.
Seize the opportunity.
Okay, thank you. Appreciate it. And I'd like to follow up a little bit on the housing and mortgage front. Just because you mentioned a couple of times there's a balance here. You try not to overcorrect, undercorrect. And also the key thing I think you mentioned is that these interest rate increases that you've seen, that we've, that you've done so far and that we've seen are still working their way through the system. So my question is whether you are concerned at all about the impact this is going to have on people with the mortgages. We just saw OSFI act to say that the risks are rising with negative amortizations. And this is just another increase that's going to push more people to that trigger point. So I wonder how you weigh that and whether you're concerned about the housing market and in terms of people's ability to manage the mortgages and the risks this has on the banks and the insurers.
Barbara, thanks for the question. I think the best way to respond is to take you back a little more than a month ago to our financial sector report. We took a deep dive on this question, and we looked at the trajectory of mortgages, how many Canadians have already seen interest rates show up in their mortgage payments, and how many we project will see as they renew their mortgages over the next year or two, we'll see an increase in payments. This is something we're watching really closely. As we said earlier, housing is one of the most interest rate sensitive parts of the economy. It is always going to be the place where monetary policy shows up first and shows up strongest. That's exactly what we've seen. We were asked earlier about surveys. We pay close attention to those surveys. We work closely with our other colleagues in the financial sector, the federal bank regulator. So these are numbers we track very slowly. About 35% of Canadian households have a mortgage. The large majority of those mortgages are fixed rate mortgages. Of course, some of those have already renewed in this rate environment. We've had increasing rates over a year now, so already people are renewing their mortgages, their fixed rate mortgages. And then we have quite a bit smaller portion of Canadians who have variable rate mortgages. A portion of those are fixed payments. So it is a gradual process. Interest rates will work their way through that portion of households with mortgages, and we'll be watching it very closely as it evolves.
Okay, here's the list that I'm going to call. Kat Eschner, Max Sato, Rob McClister, Michelle Zadikian, and then Pete Evans. So hopefully everyone can be ready. Kat, if you're there, please go ahead. I just received an email that she's all right. Max, if you're there, please go ahead. Well, this might end a lot faster than we thought. Rob McClister, please.
Can't hear you, Rob.
And, oh, there you are.
Right now.
We hear you.
All right. Hi, Governor. And Deputy Governor. In speaking with multiple lenders and default insurers, most borrowers with adjustable rate mortgages seem to be performing better than people with fixed rate mortgages. So given how much the government is now encouraging banks to help troubled borrowers, how much are news headlines about big payment increases at renewal overhyped? Or are you really worried that rate resets are going to be a problem from a financial stability and inflation perspective?
Thanks for that question, Rob. Look, there's no overhyping the pain that some Canadians are feeling. Again, I come back to the work we did, and that's outlined in box 3 of the NPR. That's exactly why we took that deep dive, because we are seeing the headlines. Raul asked this question earlier. We're seeing the headlines. We hear from Canadians too. Canadians email us about the effect of inflation and interest rates on. So we're attuned to that. I don't think we would say that it's overhyped. For those people that are feeling it, it's real. What we did in this NPR is we took a look at the question you're asking. What is it that's buffering, that's keeping consumption high, keeping demand high? And our assessment is, as I said, we see a lot of accumulated savings in Canadian households. You're in the mortgage business, you would have a good sense of who takes out a variable rate mortgage and what their capacity to absorb higher rates are. It's possible that those are borrowers who are more prepared for variable rate or payment adjustments. But it's something that we're going to continue to watch. But I don't think you can brush off the impact of high interest rates on borrowers.
Okay, Michelle Zadikian from Yahoo Finance. Michelle, if you are on the line and able to press *6 to unmute, please go ahead.
Hi there. My question is about this line when you talk about there's inflation could rise again if there's upside surprises. What are some of the potential upside risks that you're most concerned about?
Well, I think the point of that phrase is that when there are always going to be surprises in inflation. You hope they're little surprises, but if you don't get inflation back to 2, and you're around 3, and then you get an upward surprise, well, now you're back to 4. The whole point of getting inflation recenters on 2 is that the surprises, the fluctuations, should most of the time be within 1% to 3%. And what that means for Canadians is if inflation's fluctuating between 1% and 3%, basically that means 1 year to the next, they don't really need to worry about big changes in their cost of living. It gives them a certain level of certainty. It takes one problem they have to deal with off the table, and so they can invest and save and spend with more confidence that they know what things are gonna cost and what they're gonna have at the end of the year. So in highlighting that, it wasn't that there was some specific. The whole point of a surprise is a surprise. If you knew what it was, it wouldn't be a surprise. It's not that there's some specific things, but the point is, if inflation stays at 3 and doesn't come back to 2, when you get an upward surprise, you're back to 4 or higher.
Okay, and Pete Evans from CBC, please.
Hi, can you hear me?
Yes, Pete, go ahead.
Hi. If you strip out mortgage costs, inflation is actually within the target range. So can you explain to Canadians who aren't economists how making those mortgage costs even higher is going to help bring down the cost of living? Do you worry at all about losing credibility with them, with the seeming disconnect between making things more expensive so you can make things less expensive? And if you can, give me an answer in French if possible. Thanks.
Oui, je peux répondre en français si vous voulez. L'explication courte, c'est que en montant les taux d'intérêt, ça c'est comment on baisse les pressions inflationnistes dans l'économie. Si on n'a pas augmenté les taux d'intérêt, l'inflation sera beaucoup plus haut que c'est maintenant. Le fait que nous avons augmenté les taux d'intérêt est un facteur important du diminution de l'inflation qu'on a vue durant l'année passée. Oui, vous avez raison. Si les taux d'intérêt ont beaucoup augmenté, pour plusieurs Canadiens, c'est un coût. Le coût de leur hypothèque, c'est à la hausse. Et si vous enlèvez quelque chose de l'EPC qui est à la hausse, qu'est-ce qui reste est moins à la hausse. Donc oui, si vous enlèvez les coûts des hypothèques dans l'EPC, qu'est-ce qui reste augmente à 2,5 %. Mais en même temps, si vous enlèvez quelque chose qui baisse, comme la gasoline, qui est important pour plusieurs Canadiens, l'inflation est plus haute, c'est 4 %. Donc, ça, c'est pourquoi on regarde un grand panier, un éventail de biens et services en regardant l'inflation. Et c'est important de comprendre, l'inflation, ce n'est pas un changement dans un prix. L'inflation, c'est une augmentation généralisée des prix des biens et services. Et qu'est-ce qu'on voit quand on regarde le panier? Il y a plusieurs biens et services qui sont à la hausse de plus de 5 %. J'ai mentionné plusieurs déjà. Nourriture, en total, ça monte 9 %. Rents, 6 %. Les hôtels, 13 %. Les repas au restaurant, 7 %. Donc, l'expérience des Canadiens, c'est plusieurs biens de services. Encore, les prix montent encore trop.
And I'm just going to close with this as Max has emailed me his question. Is it possible for the Bank of Canada to bring inflation back to target while the housing market is relatively strong? We'll close there.
Well, actually, what you can see in our monetary policy report I think it's table 2. Table 2. So you can see the contributions to growth from the various components: consumption, housing, business investment, government, imports, exports. So what you can see is that in 2023, we've seen a big contraction in the first half of 2023 in the housing sector. So housing actually contributes negatively to growth. 2024, you've already seen the housing market start to pick up. Our forecast has that continuing with modest growth. So in 2024, housing contributes positively to growth. Nevertheless, consumer spending slows quite a bit from what it was this year, and consumer spending is a lot bigger than housing in GDP, so the net effect is that growth overall slows. So the short answer is yes. It's not surprising that you know that monetary policy is going to affect the most interest-sensitive parts of the economy, housing being the leading example. First, as housing adjusts to the higher interest rates, it will start to increase. It takes longer for monetary policy to affect consumption, and even longer, particularly consumption of services. That's still feeding through. That's going to dampen consumption growth even as housing grows modestly in our forecast. So we still have growth slowing and then picking up in 2025, but with housing growing gradually through that period.
Okay, and that's going to conclude today's press conference. I want to thank everybody for their patience and apologies for the technical issues. Thanks again, as always, to the Governor and Senior Deputy Governor, and thanks to you for joining us. We will see you next time. À la prochaine.
Thanks very much, and I hope you can have a good summer.